Hi, I'm Azad Ali, and today I have here with me Dr. Efstatios Polizos, Associate Professor of Finance and Associate Dean at the College of Interdisciplinary Studies, Zayed University. On this episode, we are going to be covering blockchain-based tokenization of financial assets, opportunities, risks, and market structure. Let's go ahead with the questions. First one, how is blockchain-based tokenization of financial assets changing the way we think about ownership, liquidity, and access in modern financial markets?
Well, tokenization is very important because it changes the way that we represent ownership. Traditionally, ownership of financial assets is it's understood, it's recorded through a chain of intermediaries. The asset itself may be a bond, a share, a real estate claim, or any other financial instrument. But the ownership itself, its structure, the ownership structure is complex and fragmented. So you have custodians, brokers, clearing houses, registrars, settlement systems, legal records. But with blockchain tokenization, we are creating a digital representation of a claim on an underlying asset. So this digital token can, in principle, be transferred, recorded, verified, and exchanged in this distributed ledger, in this decentralized ledger, the blockchain. It does not automatically remove all intermediaries, so we need to be careful not to oversell the idea, but it does change the architecture of financial ownership. It can make ownership more transparent, more divisible, and potentially easier to transfer. And this is particularly important for assets that are traditionally illiquid. So like real estate is a great example, and we have Dubai already moving into this direction with DIFC and the FSA. They have been creating controlled environments for tokenized investments for products and services using tokenized products. Private equity, private credit, investments on infrastructure, and certain types of bonds, they're also relevant. And these are assets where entry costs are high, so it's very expensive to join that market. Ownership is difficult to divide. So if you buy a building, you buy the whole building, it's very difficult to divide ownership. And secondary market trading is very limited. So through tokenization, the claim on the asset can be divided into smaller units, smaller digital units, allowing a broader group of investors to participate. So in theory, this improves access and may deepen the market. But the key word here is in theory, because tokenization does not automatically create liquidity. Liquidity requires buyers and sellers, and it requires a series of other prerequisites like market makers, valuation, legal certainty, and trust. If you tokenize an illiquid asset and there is no active secondary market, you've only changed the form of the asset, not the economic characteristics. So from a finance perspective, we need to distinguish between technological transferability that is given by the technology and genuine market liquidity. And this is where research in market efficiency and digital assets becomes relevant, because in crypto markets, we have often seen that the existence of a trading venue does not guarantee efficient pricing. So prices are affected by sentiment, by hype, by limited information, by market structure. And the same issue can arise with digital asset tokenization. A token may trade continuously on a blockchain-based platform, but that does not mean that its price is accurate. This means that it accurately reflects the value of the underlying asset. So tokenization changes how we think about access and ownership, but it also forces us to ask some deeper questions, like who has the legal claim? How is the claim enforced? How frequently is the underlying asset valued? And what happened if the token, the digital representation, trades at a premium or at a discount compared to the underlying asset? And who is responsible for alignment of these prices? So at Zayed University, these are exactly the kind of questions that we want the students in our MS Fin program to ask. So we have a fintech course. In our fintech course, we discuss blockchain tokenization beyond the boundaries of the technology. So we examine it as a financial market innovation with implications for liquidity, valuation, regulation, and investor protection.
Thank you, Dr. Polizos. My next question, what is driving the growing interest in asset tokenization and real-world asset tokenization? particularly among institutional investors?
There is a very strong interest and a growing interest, like you said. This is driven by, I think, a combination of technological maturity, institutional demand, regulation, regulatory experimentation, I would say, and the search for market efficiency. So today, we are no longer at the stage where blockchain is seen only as the technology behind cryptocurrencies. Institutions are asking whether this infrastructure, blockchain, can be used to improve the way traditional assets are issued, transferred, settled, or managed. So for institutional investors, one of the main attractions is operational efficiency. In traditional markets, settlement is very slow, reconciliation is expensive, and these intermediated ownership structures can create frictions. But with blockchain, tokenization offers the possibility of faster settlement and of automated compliance checks and transparent ownership record. This is something we haven't seen in traditional markets. And these features matter in financial institutions because even small improvements create significant cost savings, so significant profits. Another driver is also the search for liquidity in illiquid markets. We discussed this before. This allows institutions to explore whether illiquid assets, like real estate, for example, can be made more accessible and more tradable. And we said this does not mean that all illiquid assets suddenly become liquid, but it opens the possibility of new market structures. And we should also recognize the role of major institutional examples. We have projects like tokenized treasury funds, and we have initiatives like the Project Guardian in the Monetary Authority of Singapore. These show that this is not just a retail crypto narrative. In Singapore, they worked with major financial institutions to test whether asset tokenization, to give some use cases for asset tokenization. And BIS, the Bank for International Settlements, has also examined how tokenization can affect regulated financial markets. And we have examples in the UAE. There is growing interest in which is part of the broader digital asset strategy. In ADGM has a framework that covers all virtual assets and digital securities and any funds linked to them. Globally, all financial institutions are experimenting in this space, and I think this provides some confidence that tokenization is becoming a legitimate area of financial innovation, not just a niche area, but coming gradually into the mainstream. And the regulatory infrastructure here is very important because institutional investors don't move because the technology is interesting. They don't move because of the hype. They move when there is a credible, legal, and supervisory framework. And from our perspective, the institutional interest reflects something we've seen before in financial innovation. Institutions are not usually the earliest adopters. They don't move quickly, like we said before. Only once infrastructure, regulation, and market depth have started to mature, only then does institutional adoption become more serious. And we saw this in Bitcoin ETFs. Institutional participation increased when the product became more regulated and easier to integrate in the portfolios. And I expect a similar process to follow with tokenized financial assets. But this does not mean unconditional enthusiasm, because they will ask difficult questions. What is the legal status of the token? What happens in insolvency? How is compliance enforced? How is it enforced across jurisdictions? These questions are not obstacles, but they are conditions under which tokenization can become credible.
That's very insightful. My next question, from a market design perspective, how does digital asset tokenization affect price discovery, market fragmentation, and trading efficiency?
This is a great question because from this perspective, tokenization is fascinating because it can improve certain aspects of efficiency while sometimes creating some new risk at the same time. So that the technology, like we said, promises faster settlement, broader access, and transparent ownership. But markets are not efficient because they are digital. They are efficient when information is incorporated into prices accurately and when trading is sufficiently deep and participants trust the rules of the market. So you mentioned price discovery. Let's start with that. In theory, tokenization improves price discovery because it allows assets to trade more frequently and across a wider investor base. So if we have frequent trading, we have more frequent price signals, so we have more information. And this can be useful particularly for private assets or real estate or fund units where valuation can be slow and opaque. But there is a challenge because frequent trading does not always mean better pricing. So if trading is thin, or if investors don't understand the asset, or if the token trades on fragmented venues, then prices are noisy. And in my own research in crypto market efficiency, one recurring theme is that digital markets can produce large volumes of data, so the information is there, but the presence of data does not guarantee efficient pricing. And this is where market fragmentation becomes problematic because tokenized assets may trade across different platforms, different blockchains, different jurisdictions. And you might have the same economic exposure, the same underlying asset, existing in multiple tokenized forms. And in that case, price discrepancies will occur. We have that in traditional finance as well, but then we have arbitrage and market making, and these help close these gaps. In tokenized markets, arbitrage can be more complex, and this might result in tracking errors, in discrepancies between the price of the digital asset and the price of the underlying asset. This can be a key issue because, like we said before, the token represents a claim on an underlying real-world asset. In that case, its price should remain closely connected to that of the asset. When there are deviations, and these can come from multiple factors, similar to what we see in ETFs or derivative-like structures, when there are these deviations, these can erode trust in the market. And tokenization introduces an additional layer of complexity because the technology, the platform, and the legal wrapper, all these matter. And my research has shown that tracking errors increase in periods of market stress. And I think this adds a hurdle to the process. Trading efficiency, of course, is an area where tokenization can help, but like we said before, not automatically. We have the possibility of real-time settlement, automated transfer restrictions, programmable compliance. All these can support a more integrated financial system, and they are meaningful improvements. But efficiency depends on governance. Who validates the transaction? What happens if there is an error? Can a transaction be reversed? How are disputes resolved? And BIS is leading the efforts here, and this is encouraging, but this can take away from the decentralized nature of the market. So from a market design perspective, a well-designed token market, tokenized market, can improve settlement, it can improve transparency, and it can improve access. But a poorly designed one can create fragmented liquidity, unclear rights, and unstable pricing. And this can diminish the trust in the system. And this is why students in our MS Fin program, we study both market microstructure and the fintech aspect. And we prepare students to evaluate financial innovation critically rather than accept it at face value simply because it is innovative or something new.
Thank you, Dr. Polizos. My next question, what are the main risks associated with the tokenization of assets, especially in relation to valuation, custody, and the link to the underlying asset?
Well, there are new risks, of course, and they come from a simple fact. The token is not the asset itself. It is a digital representation of a claim on an underlying asset. And that distinction matters enormously in this place. So starting with valuation, if a token represents ownership of a liquid asset, such as a treasury security or a stock, then valuation is very straightforward. But tokenization is not very helpful in these cases. But if it represents a share in real estate or private equity or private credit, then valuation becomes more difficult because the underlying asset does not trade frequently, so there are fewer price signals. And the value of the asset, of the real world asset, depends on appraisals, cash flow assumptions, credit risk, market conditions. So in these cases, if the token trades daily, but the underlying asset is valued monthly or quarterly, the token price may move away from the asset value, and we might not even be aware of this deviation. So this creates the risk of tracking errors between the tokenized instrument and the underlying asset. And investors may assume that the token price reflects the value of the asset, but this is not always true. So I have often seen in my research, I have often examined how digital markets deviate from theoretical expectations because of sentiment, because of liquidity, because of information frictions. And this, the same logic applies here. You mentioned custody. Custody is another major risk. I mean, in traditional finance, custody is already very complex, but the roles are well established and well understood. In blockchain tokenization, custody can involve new ideas, new roles, like with private keys, smart contracts, wallets, custodians, administrators, even legal trustees. And if any part of that chain fails, investors may face operational risk, legal uncertainty, or even loss of access. They may lose access to the underlying asset. And for institutional investors, this matters. This matters because this is particularly important because custody is not just a technical function. It is part of governance, audit, compliance, and it is part of their fiduciary responsibility. So the legal link to the underlying asset is perhaps the most important issue. So if I hold the token, what exactly do I own? Do I own the asset directly or part of the asset? Do I own a claim on an issuer? Do I have voting rights if it's a share? Do I have income rights? And am I protected if the issuer becomes insolvent? And for now, the answer here is no to all these questions, but this reduces the value of the tokenized asset relatively to the underlying one. So we need better answers to these questions before tokenization can scale. And without legal certainty and without equal ownership rights, or semi-equal at least, equal in some form, tokenization may create the appearance of ownership without the protections associated with traditional securities. And there are also smart contract risks. A smart contract may automate the distribution of funds or may automate transfers or compliance checks, but it is humanly coded. It is coded by someone and it can contain coding errors. It may behave exactly as programmed, but not as intended. So this is a very important distinction. So intention, legal interpretation, and operational execution, all of these must align because in tokenized markets, any misalignment between code and legal reality can be very costly. And there is also regulatory risk. It is also significant. There is still some regulatory uncertainty because definitions of asset types still differ across jurisdictions. So the same asset may be treated differently across different jurisdictions. So there is some uncertainty there as well. And so you see that all these risks, they are not only technological. So we are not waiting for the technology to scale or to catch up. These are financial, legal, operational, behavioral risks. And this is why tokenization must be studied seriously in finance programs under a financial lens, not only as in a purely technological one. This is the important message that technology does not eliminate risk, but it changes where risks appear and how they must be managed.
Thank you for this clarification. Dr. Polozos, how are regulators approaching tokenization regulation, and what challenges arise when applying traditional financial rules to tokenization of securities on blockchain platforms?
This is a very difficult question. It's one that's coming up. IOSCO, the International Organization of Regulators, they have done some research work on tokenization, and they emphasize that regulators must remain technology neutral and outcomes focused. That's what they call it. And this means that the economic substance of the instrument matters more than the technological form. In simple words, it means that if a tokenized instrument, if a tokenized asset behaves like a security, gives rights like a security, and creates risk like a security, then it should be treated as a security. The fact that it sits on a blockchain does not remove the need for investor protection, for disclosure, for custody rules, and for market integrity. And I think that's a very sensible starting point. It avoids the mistake of allowing technology, the technological form, to override the economic substance. And tokenization may use new infrastructure, but it addresses ownership and underlying financial questions around issuance, valuation, custody, which are already familiar. We know them. So it is a good starting point. But the challenge is that these rules that are meant to apply to these tokenized assets, these are traditional financial rules. They were not designed for programmable assets, and particularly for ones that can move across digital wallets, across borders, and even settle in real time. In securities regulation, traditional securities regulation assumes identifiable intermediaries and defined market venues. So you have a stock exchange in New York, a stock exchange in London, and any transactions take place between those two. In blockchain-based tokenization, these boundaries are blurred, and a token may be issued in one jurisdiction, it can be held by investors in another jurisdiction, and it can be traded on a platform that uses infrastructure maintained in another jurisdiction, in the third one. So there is jurisdictional complexity here because the borders are blurred. And for reference, when we are operating across time zones, it is even challenging to define a calendar day. So all these novelties, they have to be addressed by the regulatory frameworks, even though they are based on the traditional patterns that we have already seen. Another challenge is the distinction between public and private blockchains. So some regulators, some institutions are more comfortable with permission systems, where participants are known, access is controlled, and but this resembles a traditional centralized system. Others are exploring public blockchain infrastructure because of its transparency and network effects. Each approach has advantages and disadvantages. Permission systems are easier to regulate, but they don't deliver openness and liquidity. And public systems are more innovative, but they are harder to supervise. So in the UAE, for example, we see regulators taking a proactive approach. So EDGM's framework explicitly covers all types of virtual and digital assets. And any firms that wish to conduct activities in this area must obtain regulatory permission from the FSRA. And this creates a pathway for innovation within a regulated environment. And this is exactly what institutional investors need. And also we see experimentation internationally through regulatory or industry-led initiatives like the Project Guardian that we discussed before. And I think this initiative suggests that regulators do not want to stop tokenization. They want to understand how to scale it safely. And there is a challenge here, a very big challenge, how to balance innovation with investor protection. Because if regulation is very restrictive, tokenization may not develop. The market may not develop. But if it is too loose, we may see weak custody standards, unstable platforms, loss of confidence, and we may have adverse results there. So the goal should be to allow experimentation while ensuring that tokenized financial assets meet all the regulatory standards regarding disclosure, governance, and accountability. And this is why financial education matters today, because the next generation of finance professionals will need to understand regulation not as an obstacle, but as part of market design. And in our MSFin program, our students are trained on financial fundamentals, but also understand innovation. And that, I think, bridges the gap between regulation and innovation and for the coming years.
My last question for today, Dr. Pozos. Looking ahead, do you see blockchain tokenization becoming a core part of financial infrastructure, or will it remain a complementary layer to existing market?
It's always difficult to guess the future, but I think blockchain tokenization can become an important part of financial infrastructure. Probably not overnight, and probably not uniformly across all types of markets. I would be very cautious about predicting a sudden replacement of existing systems. Like suddenly we will send money through blockchain and nothing else. Financial institutions are very conservative, and for good reason. They operate under very strict regulation. They have fiduciary responsibilities. They manage systemic risk, and they rely on infrastructure that has been developed over decades. So these systems don't change quickly. But I do believe tokenization can gradually become embedded in certain parts of the financial system, especially where it solves clear problems. So, for example, collateral management or fund distribution, access to private markets, cross-border settlement. tokenized money market instruments. These are areas where blockchain tokenization may offer practical benefits. And if the technology reduces friction, improves transparency, and lowers operational costs, institutions will adopt it. BIS has also suggested that tokenized systems could incorporate central bank money, commercial bank deposits, and government bonds. They can bring that into a more integrated financial architecture. This is a very strong signal that tokenization is not only a crypto market issue, but it is increasingly part of a conversation about the next generation of financial infrastructure. But at the same time, like we said before, we should not assume that every financial asset needs to be tokenized. Public equities already trade efficiently in many markets. Government bonds, they have deep institutional infrastructure. For these assets, tokenization must offer some clear improvement, not just technological novelty. Financial inclusion could be one of those improvements, but this remains something to be seen. I think the stronger case, again, for tokenization is where markets are inefficient, fragmented, or difficult to access. And we might also end up seeing a hybrid model. We might have tokenized markets developing alongside traditional markets, with some assets remaining in conventional systems, other assets being issued directly in tokenized form, and some assets existing in both forms, in parallel or in different trading platforms. And this is where finance professionals will need new skills. They will need to understand traditional finance. They will need to understand it deeply because it is the backbone of the system. But also they need to comprehend blockchain infrastructure, digital custody, smart contracts, tokenization, regulation, and market design. Because the profession will not be divided neatly between traditional finance and crypto finance. The future will involve convergence. This has implications for education. And in the MS-FIN program in Zagreb University, we give the students the opportunity to engage with emerging topics like digital asset tokenization. But the goal is not to train students to follow buzzwords. The goal is to give them the analytical tools to evaluate whether a financial innovation improves market outcomes, and if it introduces any new risks, and also, or if it simply repackages existing structures. And I think this is why the topic matters, because tokenization is not only about blockchain, it is about the future organization of financial markets.
Thank you, Dr. Polizos, for your in-depth insights.